and there's it's new blockchains and new layer twos that will be improving the transaction costs and new protocols that will be providing better services for customers.
The blockchain space is evolving very, very quickly, so it's important to keep tabs on the latest developments in DeFi, and that's exactly what we'll be talking about right now with John Eagleton. He is the CEO of Intellabridge, and he'll be talking about the cash ecosystem. Welcome to the show.
Yeah, thanks for having me.
John, let's talk about cash first and foremost. We're talking about offline, the utility of DeFi and how that's evolving every day very quickly. Tell us about the latest developments in the DeFi space that are impacting the everyday consumer and retail investor.
Well, DeFi is actually a very complex space. It's built on blockchain. If you want to actually get into DeFi, you have to install a Chrome browser like MetaMask. You have to be able to store your seed phrases, your passphrases, being able to move in and out of different DeFi money markets. So at Cash, what we do is we abstract those complexities, offering customers basically a banking experience, but better than a bank because you're able to access these high money markets on DeFi.
Okay, can you expand on that? How exactly can you access these money markets?
So just for clarity, so DeFi is basically new money markets on the blockchain. These are borrowers and lenders on the blockchain who are borrowing and lending US dollar stablecoins. So these can be US dollar stablecoins on Ethereum or other blockchains like Terra. And by putting borrowers and lenders together in smart contracts on the blockchain, you don't have a situation like traditional banks, where in traditional banking, they're borrowing your money at less than 1% and then lending it out for credit cards, mortgages, and other loans at much higher interest rates. So the banks make a decent spread between the borrower and lender. With DeFi money markets, individuals are able to borrow and lend directly peer-to-peer and have the benefit of interacting directly on these higher rates. So what Cash does is it really makes it simple to access those money markets. It's basically like a traditional bank account where you log in, you set up your account, you have a checking account, you have a savings account. The checking account's just like a traditional checking account, but you've got dollars in there and you have dollar stable coins, and you can move those funds into a savings account where you can earn up to 20% interest rates.
All right, I want to come back to that 20% APY. That's a very high number even for the DeFi space. But John, let's talk about your analogy, the checking account and savings account. So per this example, what's in this checking account exactly? So you got fiat dollars and what else?
Yeah, fiat dollars and stablecoin dollars. The advantage of stablecoin dollars is multiple. One, if you want to send money for remittance purposes, it's much cheaper than sending via Western Union, for example. It costs 5 or 6 cents as opposed to 5-10% interest rates and transfer rates. And you can transfer those stable coins into a savings account where you're able to access these DeFi money markets.
Okay, and is there a transaction fee involved?
The transaction fee is like 25 basis points. So those are the network fees on the blockchain. We actually don't charge any fees for that. Okay. So that's 25 cents to deposit $100 or $1,000.
Okay. Well, can I deposit any coin that I have in my wallet, or does it have to be a native token to your ecosystem?
It's actually not we're built on multiple ecosystems. So we're built on both Ethereum and on Terra blockchain. So it can be Ethereum stablecoins like USDC or DAI, or it can be the Terra stablecoin like UST.
Okay, thanks for clarifying. I can't put Bitcoin in there?
No, we currently don't support Bitcoin. It's designed for stablecoin earnings.
Okay, now let's just talk about that. Stable coins on Bitcoin, is that under development by either yourself or anybody else right now?
Yeah, there are people working on that, but that's not something that we're currently involved in. What if a protocol, a Bitcoin protocol, or there's a Bitcoin money market, or any other blockchain, Solana, or any of the others, we evaluate all those different blockchains to determine what we think would be best for our customers.
I want to come back to 20% APY. How exactly is that generated on your platform?
So we're built on the Terra blockchain, and Terra has a protocol called the Anchor protocol. Terra actually had the advantage of building their blockchain after Bitcoin, after Ethereum, and looked at basically building a better blockchain, a better solution. And what they did is they decided to anchor an interest rate around a 20% rate, fixed rate, to provide investors with fixed rate. A lot of the money markets have very volatile rates. You'll have very high interest rates in the beginning. Those will taper off to much lower rates. And they wanted to create a fixed rate platform. The way they do that is that they allow borrowers to deposit either Terra tokens or Ethereum tokens into as collateral for those loans. And borrowers have to put up at least 200% collateral. Those, and often they're putting more like 300%. So those loans are over collateralized, and the underlying collateral is earning on average around 10%. So if you put in 200, if you put in 200% of that, you're actually getting double the interest rate. So you're getting about 20.
Do you see a scenario in which interest rates in the DeFi space go down in the future as, I guess, more entrants come in and there's more competitors for loans?
Yeah, rates will definitely come down. These are almost like teaser rates, and some protocols, their teaser rates are extremely high. You can get 50, 100% yields, but those only last for a few months. They're trying to attract liquidity into their protocols, and they do that for a very short period of time. The protocol we're built on has a much longer term vision of maintaining high rates, but those rates will come down as more demand for lending and borrowing.
Okay, so John, the 20% APY, is that locked in as a fixed rate for a fixed amount of time?
It's actually a variable rate. So it's been like right now it's at 19.45%.
Right.
It's been over 20%, and it's been below that rate. So it's volatile.
The U.S. Federal Reserve has already hiked rates for the first time since 2018. People are projecting that they'll hike more rates down the line this year, perhaps into next year as well. Do you think that's going to have any impact on the DeFi market in terms of how or where rates are headed in the DeFi market as well?
I don't think so. I mean, from a macro perspective, probably maybe yes. It's the DeFi markets is more about in inflation rates over 7% right now. The average American household is saving less than 5% of their disposable income in savings accounts, and that's because interest rates are less than 1%. DeFi offers much more attractive yields for people who want to save, and is helping to encourage better savings.
Well, presumably, when interest rates are as low as they are in the United States, and where inflation is very high, close to double digits, not quite, but 7.9% was the latest reading. You would think that people would want to move into a higher yield environment, and DeFi offers that kind of space, right? Wouldn't you see more capital flows in a higher inflation, low risk environment?
Yeah, absolutely. So take Anchor Protocol as an example. A year ago, there were just a few $100 million in the protocol. Now you have over $15 billion in the protocol. So yeah, a lot of money is moving into protocols like Anchor.
Is that mostly institutional money or retail money?
It's a mix of both. I don't know, what the exact breakout is because it's decentralized. So yeah, those numbers are not readily available.
Okay. Well, the going back to the interest rates, 20% APY sounds very attractive, but it doesn't come without risk. Every protocol has risk. So somebody who is maybe attracted to that yield might be wondering, well, John, what's the downside risk for me?
Yeah. So yeah, definitely risk, and that's one of the I think continued barriers to entry in the DeFi space is complicated user experience. How do I get in? How what are the risks and so on. So that's something that the ecosystem and companies like ours are working to solve for.
Yeah.
There are insurance protocols that are coming to market, so we will be offering insurance on Anchor Protocol that protects against technical and security risks. And then there's risks of depegging from the US dollar. So right now, $1 US equals $1 US dollar stablecoin. So we can provide customers with insurance to protect against those risks.
Well, John, how significant are counterparty risks? Should we be concerned that maybe there could be a default on any of your counterparties such that your loan obligations can't be covered?
Yeah, so that's the difference between what we're building and maybe some of our competitors offer, like BlockFi, Celsius, and so on. Those are they are offering centralized lending solutions. So someone puts in, lends the money. There's a bar on the other side. They're taking on counterparty risk. So with algorithmic stablecoins and smart contract-based protocols, there is no counterparty risk because there's enough collateral, 200, 300% of collateral that will automatically get liquidated if the value of that collateral goes down. So that's the great thing about algorithmic stablecoins and these smart contract protocols.
So you've obviously worked with a lot of different protocols. In your opinion, which new projects or maybe existing projects do you think have the most potential to gain critical adoption mass right now? By critical, I mean something that could potentially compete with Bitcoin in terms of trading volume down the line.
Well, I believe the Terra blockchain can do that, and that's why it's gone from last year it was ranked to probably around 100. Now it's the top 5 blockchains, and it's actually the biggest in terms of DeFi assets that are held in the protocol, and that continues to gain traction because of the way it's been built. Very low cost, 6 seconds to settle a transaction. You can't go to a coffee shop and pay for a coffee with your Bitcoin directly off the blockchain. Because it takes 10, 15 seconds to settle. With the Terra blockchain, it takes 6 seconds and costs just a few cents. So it's much more compatible especially for emerging markets, emerging market countries, and for payment solutions.
Well, John, when I go to the coffee shop and I take my phone and I use my Samsung Pay app and I scan the NFC device, it doesn't cost me anything to transfer fiat dollars to the coffee shop. It's still costing me a few cents is low, but that's still a cost. When are we going to see a total elimination of transfer costs when it comes to payments?
Well, yeah, from the user perspective, it doesn't seem like there's costs associated with a payment at a coffee shop, but there are infrastructure costs that are built. You're paying through other business models. So with stablecoins, these protocols, you're able to hold your money into a high yield interest account, 10, 15, 20% earn yield on that. When you're not spending for your coffee, you're not paying for items. So that's I think the real benefit of being able to use these high yield protocols.
Well, just going back to the cost question, what developments are being made right now to reduce costs overall, not just in your platform, but overall in the DeFi space? When it comes to using cryptos as a form of payment, what developments are being made right now to reduce the cost of transactions?
Well, that was if you look at the evolution history of the space, you just have new blockchains that looked at the previous blockchain, said, okay, how do we improve costs and so on. So on the Ethereum blockchain, they realized cost was a problem with all the NFT transactions. Gas prices went up, transaction fees went up. So they built layer 2s. So layer 1 is the actual blockchain. Layer 2 is like another settlement layer that is sort of like a side chain that makes things go faster and then reduces costs. So there are different. Either you build a new blockchain or you build a layer 2.
Well, that was my question. So, what, in your opinion, what is the more optimal solution here? Building a layer 1 that has that is optimized for transactions, basically a coin that is purposely built for payments, or we build a layer 2 on top of existing blockchains like Lightning Network, for example.
Yeah, so I think you're going to see multiple blockchains. You're going to see a lot of hybrid models. There's I think it's going to take over the course of the next 5-10 years, you're going to see new blockchains coming to market. So it's still very much an evolving space, and there's it's new blockchains and new layer 2s that will be improving the transaction costs and new protocols that will be providing better services for customers.
I'm just curious to see or understand your professional background. You previously worked at the U.S. State Department, and now you're in the blockchain space. How did that career transition take place?
Yeah, so I was working at the U.S. State Department, and I was recruited by BNP Paribas Emerging Markets Trading Desk to trade fixed income bonds for emerging market countries, Latin America, Eastern Europe, and so on. And it was actually in the .com days, a friend of mine and I, we were looking at Wall Street analyst recommendations and saw that no one was actually tracking the performance of Wall Street research. We built a platform to do that, to provide it to firms like JP Morgan, sell-side firms, retail investors, and so on. In 2016, we were building a P2P lending platform and looking at how we could optimize payments, how could we reduce transaction costs, and that's when I actually read Tapscott's book, Blockchain Revolution, and realized the power that blockchain had to transform, financial markets and so on. So sort of evolved from there to where we are today.
You've worked for both, I guess, the public sector and the private sector. Are you surprised that the latest developments in DeFi came from the private sector first? You would think that governments would take the initiative to, I guess, provide better forms of transactions for fiat currencies. Aren't they incentivized to keep the dollar competitive when it comes to international trade or domestic trade?
Yeah, well, the private sector is very innovative. They move very fast. Come up with a lot of new solutions. I mean, you just look at stable coins, centralized stable coins, algorithmic stable coins, hybrid stable coins. Even the regulators are challenged in keeping up with the fast moving space. Governments obviously see the benefits of blockchain. A lot of governments are looking at CBDCs; those are central bank digital currencies, to optimize, antiquated payment rails that built in the 1970s. So yeah, I think a lot of this technology innovation has to come from the private sector.
Sorry, CBDCs you think are meant to improve on existing payment rails or completely replace them?
Well, they essentially they'll, I think, it's going to improve, the replacing, but at the same time, I think the two will be, the CeFi and the DeFi will need to work in sort of a hybrid model for the next 5-10 years.
Yeah.
Simply because everyone works on traditional payment rails.
How much of a threat is CBDCs to the DeFi ecosystem right now? In the sense that if, let's say, there's a government mandate to convert X amount of your fiat dollars to CBDCs, or maybe my salary will down the line be paid with CBDCs, is there a need for Ethereum or Solana or Terra?
Yeah, so CBDCs is just basically digitizing the dollar or the euro, whatever currency it is. The government's not building, money market protocols where people can earn interest. They're not, coming up with, remittance solutions or payment solutions. So I think, the CBDCs and the, stable coins and other cryptocurrencies will be working, working together from a user perspective. So people will have CBDCs and stable coins in their wallets.
Okay, so in theory then, if I had CBDCs in my wallet, could I come to you, Intellabridge, and your cash DeFi system and say, hey, look, I want to put my stable coins, I want to put my CBDCs into your system and earn a 20% APY. Is that possible?
We would provide the mechanism for you to exchange your CBDC into the stable coin that's compatible with that protocol. So if it's an Ethereum protocol, you would have to convert it to an Ethereum stablecoin like USDC or Tether to put into the protocol. If it's Terra, you can exchange to a Tether stablecoin.
But there's probably an exchange fee involved in that. I want to just directly earn a yield on my CBDCs. Is that a protocol that you could possibly work on in the future? We could. Our strategy is actually to build on top of existing infrastructure. So we're focused on a consumer-facing application, and if other companies or teams build that infrastructure, we can integrate it. Okay. Finally, let's talk about security, and then we'll wrap it up there. So people might be concerned about hacking and stolen or lost. We talked about counterparty risk. Let's talk about the cybersecurity aspect of stablecoins. Is that something that is probably concerning for some of your clients?
Yeah, I think that's concerning for a lot of people. They read about what happens in the market with hacks and so on. What we've actually really put a lot of effort and focus onto the security aspect. We work with Taurus Labs, which has built a very elegant and secure solution for customers not to have to manage private keys. So in the DeFi space, as I said earlier, if you want to go into the DeFi space, it's actually very complicated. If you lose your private keys, you lose your money. So we've solved that with Taurus Labs from a private key sort of security perspective. There are other layers of security that we've built into our product and continue to build into our product with hardware security as well as software security.
Okay. And you have employees in Ukraine. This is a situation that affects everybody. So for a tech company like yourself, how does that affect your operations, the war in Ukraine and your employees who are based there?
Yeah, so I'm actually based in Europe right now. I'm actually a Ukrainian resident myself, even though I'm a U.S. citizen. So I've been going in and out of Ukraine since 2016. We have about 40 people in the company right now, and about 15 of them are Ukrainian. Some of them did get out prior to the events, and we're doing our best to help those who need assistance, providing them with relocation solutions and so on. And in fact, there is a big problem right now with Ukrainian refugees because they don't have access to the banking system in Europe. There are concerns about the banking system in Ukraine, getting access to funds. There's limits and so on. So we're actually bringing to market a solution for the Ukrainian refugees.
Well, that's an excellent point and a great initiative. So what is that solution? So let's say I'm a refugee from, it doesn't matter. I mean, Ukraine is one example that's currently happening, but the same could be applied to presumably any refugee from any corner of the world. If you're traveling from one place to another, you don't have access to a traditional bank account. What can you do? How can you access capital? What's the next step in this evolution that can provide refugees with access to finance?
Yeah, so the DeFi does solve a lot of those problems. There's 1.7 billion people globally that are underbanked or unbanked, don't have access to traditional financial services. Blockchain and DeFi solves that. In the case of Ukrainian refugees specifically, the problem is not being able to have just traditional bank accounts. And because we built a hybrid model combining both DeFi banking and traditional banking, we're able to offer those refugees that solution. We're working very closely with our banking partners in the United States to basically allow them to open bank accounts and fund those accounts and be able to operate wherever they're living as refugees.
Okay, but you offer the solution to convert whatever's in those accounts or wallets into local fiat currencies, whether it be euros or any other locally denominated fiat currencies. Is that a solution that you can offer?
Yeah, exactly. So the ability to hold fiat currencies, dollars, euros, sterling, in an account, to be able to spend that with a MasterCard, for example. And if they want, they have the option of moving their funds into a savings account and earning high yield. Obviously, that's not really the priority. The priority is just basic banking services. So that's something we're focused on.
All right. Well, good luck with that initiative, and I hope to speak to you again soon. Thank you for your insights in the DeFi markets.
Thank you.
And thank you for watching Kitco News. Don't forget to subscribe to our YouTube channel. I'm David Lin.